All right, let's dive right in. If you've got an exam or a test coming up on market economics, you are in exactly the right place. We're going to break down all the core concepts you absolutely need to know and make them super clear. So, here's our game plan. We'll start with the basics. What even is a market? Then we'll get into how we, as consumers, behave, talking about the law of demand, that famous demand curve, and a cool concept called elasticity. And finally, we'll put it all together to find that sweet spot called market equilibrium. Okay, first things first. Before we can talk about anything else, we have to define the playing field, the arena where all this economic stuff actually happens. So before we get into all the cool graphs and laws, we have to answer this fundamental question. We hear the word market all the time, but what does it really mean in economics? The key thing to remember is that it's not always a physical place. A market is really just any situation where buyers and sellers can connect. It could be something huge, like the global oil market, or it could be the entire US market. As long as an exchange is happening, you've got a market. Now let's zoom in and focus on just one side of that exchange, the buyers, us. There's a fundamental rule that pretty much predicts how we all act when we're shopping. Okay, this definition sounds a little textbooky, but there are two words here that are absolutely critical: willing and able. For demand to actually exist, you need both. And this is a major point you'll see on tests. Think about it. I might be willing to buy a private jet, but I'm definitely not able to. So in economic terms, I am not part of the demand for private jets. You gotta have both the desire and the cash. This is the big idea, and it's something we all know from our own lives, right? When something goes on sale, we're more likely to buy it, and when the price goes way up, we buy less of it. It's that simple inverse relationship. One goes up, the other goes down. So how do economists take that simple, intuitive idea and turn it into something they can work with? Well, they draw a picture, and it happens to be the most famous graph in all of economics. It all starts with just plain old data. This is called a demand schedule, which is just a fancy name for a table. It shows you, hey, if an energy drink costs $1, people will buy 17 a week. But if you jack the price up to $3.50, they'll only buy 2. Simple as that. And here's where the magic happens. You take all those points from the table, plot those on a graph, and connect the dots. The line you get is the demand curve. And see how it slopes downward? That's just a picture of the law of demand we just talked about. Now, pay close attention, because this is a huge point for any assessment. If the only thing that changes is the price of the product itself, you just move up or down along this line. You don't draw a new line, you just slide along the one you already have. And this is maybe the number one thing that trips people up on exams, so let's be crystal clear. A price effect that's moving along the curve is not the same thing as a change in demand. A change in demand is when the entire curve actually picks up and moves. So you're probably asking, what makes the whole curve move then? Well, it's these outside factors. Stuff like you getting a raise at your job or a product suddenly becoming super trendy. These things, called determinants, change our buying habits at every price, which is why the whole curve has to shift. So we know that if price changes, the amount people want to buy also changes. But the next big question is, by how much? Are people going to totally freak out over a small price change, or will they barely even notice? This rubber band analogy is the absolute best way to remember this concept. If demand for a product is elastic, it's like a really stretchy rubber band. A small change in price causes a huge change in how much people buy. If it's inelastic, it's like a stiff, old rubber band. You can pull on the price, but the quantity demanded just doesn't stretch much. And that's all the official definition means. Price elasticity of demand is just a way of measuring exactly how responsive, how stretchy our buying habits are when a price changes. And this shows you why it matters in the real world. Think about inelastic goods like medicine or gas. They're necessities. If the price goes up, you still pretty much have to buy them. But for elastic goods, the wants, the luxuries, if the price of that designer bag goes up, it's pretty easy to say, nah, I'm good, and just not buy it. Okay, it's time for the grand finale. We've spent a lot of time on the buyer's side of things with the demand curve. But to see how a market really works, we need to bring in the other team, the sellers and their supply curve. Let's see what happens when they meet. And there it is, the X on the economic treasure map. That spot, labeled E, is the equilibrium.
It's the one single point where the buyer's demand curve crosses the seller's supply curve. It's the point where both sides are in perfect agreement.
So, what's so special about that one point? It's where the market is perfectly balanced. The amount of a product that people want to buy is exactly equal to the amount that companies want to sell. There are no shortages, and there are no wasteful surpluses. It's just right. And this is how everything we've talked about connects. Remember those factors that can shift the whole demand curve? Well, when that happens, like if a product gets a ton of good press, the old equilibrium point is gone. The market has to find a new balance, and you end up with a brand new equilibrium price and quantity. And that's a wrap on our core concepts study guide. We've covered what a market is, how demand works, and how it all comes together at equilibrium. To really make this all stick, chew on this question. What kind of real-world events could happen that would throw a market totally out of balance and force it to find a new sweet spot?